Welcome to Global Money Talk, brought to you by Sempro TV. Greetings to all of our viewers from across the U.S., Korea, and around the world. We're coming to you live from the floor of the New York Stock Exchange in New York City, the financial capital of America. I'm Remy Blaire. At the December Fed meeting, the Federal Reserve cut its benchmark Fed funds rate by 25 basis points, as widely expected. Meanwhile, the dot plot does project the Fed lowering rates to 3.9% next year, indicating fewer cuts than in September's projection. And the Fed's PC inflation expectation for 2025 also rose to 2.5%. Fed Chair Jay Powell said the slower pace of rate cuts reflects hotter inflation readings in recent months and higher inflation expectations. Well, joining me here at the New York Stock Exchange to weigh in today is Larry Dyer, fixed income strategist. Larry, thank you so much for joining me today.
Thank you, Remy.
Well, we are here the day after the final Fed Reserve meeting of 2024. So first and foremost, what is your summary of the FOMC meeting?
Okay, well, I think the key things are, one, they cut 25 basis points. That was as expected. They had very little change to the forward-looking language in the statement. So given that, you'd expect it to be a very quiet day. That wasn't the case. And the reason is that they also updated their economic projections quite a bit, and that shifted the forward guidance, and I think it caught some investors offsides, and that the Fed seemed to be more hawkish than anticipated. As an example, they took the Fed funds forecasts for 2025 and 2026 up close to 50 basis points. So that's quite a move when you met expectations this year and you changed things so much for the next year. So that's sort of the main things, and the Treasury market reacted to that. The instant move was about 10 basis points, but we could see some further follow-through. I guess today you try to figure out how the political issues with the budget, passing sort of a new spending bill for the for the rest of the year and to tide us into the start of the next administration. How that uncertainty now begins to affect the market as well as a more hawkish Fed outlook.
And Larry, as you mentioned, there are now concerns about the potential for a government shutdown. We'll see how all of that plays out in the next 24 to 48 hours here. But here in the U.S., as you mentioned, after the Fed rate announcement yesterday, we did get the summary of economic projections, as you had mentioned, as well as Fed Powell's comments following that announcement and the projections. So what do you make of the projections? Give us your detailed analysis of the summary.
Thank you. Well, I brought in a chart and we circled some of the key points for it. So perhaps you can bring that up and then talk to people about just the key changes and what drove them. I thought it was interesting because listening to the press conference, it sounded like this might be about the election or some other component to it, but it's really about what happened in the economy in the fourth quarter. And we can take a look at the projections. I think they're up on the screen now. I've got 3 red circles. The first one is looking at the GDP forecast for 2024. In September, that was 2%. 3 months later, it's 2.5%. That's, to an extent, backward looking. It's really saying that fourth quarter, the expectations for the year shifted up 0.5%. That's a big number over a short horizon, and that changes the narrative for the Fed outlook a good deal. The other change that we see in the second component is the core PCE. Now that's the Fed's focus. And in the press conference, a lot of questions, why core PCE? Core PCE we see moves a lot less than headline PCE. You take out energy and food. Well, if the Fed hikes rates, is it going to make it rain if there's a drought and you have less food? No, right? Is it going to make people find more oil? No. You take those out because you can't control them as a central bank. You kind of let that work through the system. All right? Now, if we look at what they can control, it's to try to control core inflation in the long run. What happened to inflation? If we go back to the charts, we can see it's up from 2.6 to 2.8 in 2024, and up from 2.2 to 2.5 in 2026, and from 2 to 2.2 I'm sorry, 2 to 2.2 and 26, and the other number was 25. Those are all pretty big moves. The Fed is saying their consensus view on inflation is it's much stickier than they thought in September. Now, when the Fed said inflation would be transitory, when you look at how inflation behaves, that takes years to work its way through. People thought it should take months or a year. So I'm not surprised inflation is a bit stickier than the Fed expected. It's hard to really get that number with a high degree of certainty. We can look globally and see the Canada, Europe, and China are slowing. Eventually that hits the U.S., but for now, the U.S. market is kind of ignoring that outcome. So what we're seeing in this is the Fed cannot come back and change what it did in September or in the other meetings. It can only change what it does going forward to reflect the past shift in GDP. Equally, expecting more inflation going forward is also pushing up interest rates. So that gets us into the median Fed funds projection, which is the bottom of the chart. And here you can see Fed funds median projection for 2025 went from 3.4 to 3.9. For 2026 from 2.9 to 3.4, 250 basis point increases. Now, if that was complete new news to the market, the 2-year note yield should have jumped 50 basis points yesterday. So people said, yeah, the Fed's probably going to have to be more hawkish, but this came in a bit more hawkish than people expected, and it caught traders, I think, a bit off sides. So we've seen bond yields jump up, and in turn, with this forecast of a tighter Fed, we see pressure in the equity markets kick in.
And as you mentioned, GDP, growth, inflation, these are key indicators we'll keep our eyes on. This morning we got the revision for the latest quarter for GDP, which came in higher than expected at 3.1%. And here we are at the eve before personal income and spending. So that means we will be getting a reading of PCE before the end of the week. So these are things we need to keep our eyes on. But I do want to get your take on both the labor market as well as inflation in the U.S. since you highlighted this. As you mentioned, inflation headline has come in higher than expected and obviously above the 2% that had been mentioned previously by the Fed. So what does all of this mean heading into the new year?
Well, I think it depends on just how you try to think about it. I don't like to do a point forecast because you're guaranteed to be wrong.
Yeah.
You read the newspaper, the best forecast in June is often the worst in December. I had a talk with a friend who runs a large bank portfolio about what could happen in the next year. It wasn't a point forecast, it's what could the best outcome be, what could the worst outcome be. And that determines your risk.
Yes.
You don't want to be right in the near term and bankrupt in the short term. You want to know how to control your risks. So when we look at the world today, we can say, well, the market is beginning to price in the upper end of the Fed expectations. If we look at the Fed dot plot, the range of the dots didn't change a lot, but the distribution changed. It went up. There used to be about 3 equally sized sets of dots if we looked at the 2024 set. Now there's a broad consensus at that 3.9% rate level. So we've shifted from a wide range of potential into the upper end of the expected range for the Fed forecasts. That could shift a bit further, but if you think about it, if the interest rate acts as a brake on the economy, then we saw a 5 and change Fed funds rate slow down the economy. We saw 5% bond yields slow down the economy. And that was in a period when the rest of the world was doing okay. And when the U.S. had a large amount of stimulus. So I don't see a magic wand waving saying we're going to have a lot of extra growth this year. I actually see some risk to a very, very conflicted government going forward with questions about what will come next and how that affects investment, right? If you think the government's going to cut $2 trillion in spending, that's going to have an impact on a lot of industries. Uh, that's going to have an impact on, do you really want to take a risk? So the uncertainty is one headwind that we see today. I don't have an answer for it, but I think that when I look at the market, we're pricing in a near-term upper end of the range. We could see a more aggressive Fed, but still see limited upside risk to bond yields in a conventional environment. I'd mention something unconventional, though, which is what's happening with the budget, with spending, etc. I try to avoid politics as much as possible.
Yes.
It only ticks off people at a party. uh, and there's not much we can do about it individually. But it does lead into the idea that there's a lot of uncertainty that people have to deal with in the near term. If we look further out in the market, what has shifted? Well, the Fed funds for December, if we look at the CME data, we don't need to show the chart, it was 60-40 in favor of a cut. Before the Fed moved, it was 98%, so we knew there was going to be a cut. The 2025 December data shifted up about 25 basis points with additional uncertainty. So my base case would continue to be, gee, we're looking at something closer to a soft landing and thinking about how the bond market should shift if we really do get a soft landing. What's the upside risk? Well, we saw 5% and change slowing down the economy. We're north of 4.5. We had many periods where we got below 4% when it looked like the economy was slowing, and we have that one wild card.
Yeah.
The Liz Truss moment where the market says, you're not paying me back, so I'm not lending you money. That's fixable, as we saw with Liz Truss, but we saw gilt yields jump 100 basis points before the event. So that's the wild card, I think, at this point for investors to think about. And it really does cloud the outlook for a bit. So the answer might be enjoy Christmas and see what happens in January rather than try to really predict the next things in the next few months. We won't know until after the inauguration just how the government is going to function. The difference between being in opposition and running the government is you're now responsible for the outcome, and people tend to behave differently in that case. So we'll see what happens going forward. I always highlight that when Trump was elected in 2016, the initial view was they're going to be tariffs in a recession, and it changed almost instantaneously, and there was a 100 basis point shift in 10-year note yields. The one thing I know, or I think I know, I don't think Trump wants to cause a massive recession in his first year in office, right? In that case, he loses Congress, and his reputation isn't so good. So we'll see what happens, but you have to wait until he's really responsible before you see what he's going to do.
Well, Larry, as you mentioned, we do not have a crystal ball, and there are plenty of expectations when it comes to policy, both on the fiscal side as well as monetary side, but we will have to wait until January of next year to see how all of this unfolds. And I know that you prefer to stay away from politics, but if you had looked at some of the headlines yesterday, post-Fed meeting and post-Powell press conference, there were a lot of expectations of how Trump's administration would be affecting inflation. But I do want to dive deeper into Powell's commentary at his press conference. He did mention that in terms of yesterday, it was a closer call and it is a new phase. And he also mentioned that we're going to be cautious about further cuts. So what did you find most interesting about Powell's press conference and his statement?
This sort of the recognition of the uncertainty in the outlook, the idea that they kind of know that they can control inflation going forward with monetary policy, but what's uncertain is what will it take to control inflation? You look at the dot plot and you see a 100 basis point range or more for the near-term outlook. You see, the longer-term outlook varying close to 100 basis points,
Mm-hmm.
70 basis points. So they really don't know the answer. I don't think that's unusual. We have been feeling our way through what the right rate structure is. Um, there are a lot of simple rules for the economy, and if it's easy, I'll say you're doing something wrong. And if it's hard, you don't really have a clear answer to what is going to happen. And we can look back at history and see that. So if we start with a base case of a soft landing, what does the Fed do in a soft landing? And what do rates do in a soft landing? And I've got a chart that highlights just one. There aren't that many soft landings. Often events drive them, but I labeled 3 here. If we look in the 96, 97, 98 period where I have the first arrow going down, you see the Fed, after tightening a bit too much in 94, eased and then held the funds rate stable. And we have a breakout chart on the next page that we can flip to. So this shows what happened to the economy. Now, in the 90s, there was uncertainty of was inflation going to run at 4%, 3%. New Zealand was targeting 2%. People thought they were crazy. Now 2% is the consensus, right? So things change. So we can't take this 100% clear, but we can see between 96 and 98, the Fed had 125 basis point hike. That's a pretty stable monetary policy. We had a fairly steep yield curve. Why? Because you didn't know if inflation was fully tamed, if it was going to be 3% or if it was going to go to 4%. Over time, the Fed hiked one more period, and we started to see the economy slow down, and eventually you had the Asian debt crisis and long-term capital management kick in. But in this case, we had an equilibrium 10-year note yield, which had a bit of a term premium. It was 100 basis points or more above the Fed funds rate. Now, if we look at another period with a soft landing, we see the term premium tended to drop, and I think that's reflective of today. This is the most recent period. I'd call it kind of a soft landing scenario. Why? Well, the yield curve inverted as the Fed was hiking. That's investors saying, in the long run, we think we know what the longer-term Fed funds rate should be, and we can price 10-year note yields off that. In the short term, the Fed raised interest rates and pushed up 10-year note yields and pushed up short-term borrowing costs. So we see that soft landing expected. There's been a little bit of noise, 50 to 100 basis points, probably a 50 basis point or more shift in the expected equilibrium for the 10-year note yield. And we've also seen the long-term Fed funds rate shift up from 2.5% to 3%. The Fed is following the market with that move. They might continue to push up the Fed funds rate. If we were saying, what will an economist predict the equilibrium Fed funds rate is, historically, without the Great Recession hitting us after the housing crisis, you'd look at something closer to 4%. It's 100 basis points above the current estimate. So there's still some potential that we could see, gee, in a year, 2 years down the road, inflation is sticky, and that longer-term Fed funds rate keeps moving up. And that might push up longer-term yields a bit, but relatively slowly. So this is looking like a soft landing with the 10-year note hitting a range. And in that period, you can have month on month of really boring trading. I hate soft landings. It's harder to make money. You have to have a short-term view, and it has to be right. And you can have a debate about, is the equilibrium going to be 3%, or is it going to be 3.5%, which would be shifting the long-term rate outlook a bit more. And you see that in these shifts from 4% to 5% in the 10-year note yield in this chart. I don't think we shift significantly above 5% as a long-term number. That should be attractive. We're getting closer to it. We're even closer today. I think we're about 456. But the timing can take a few months before the market says, oh, I'm more comfortable with the economic outlook, I'm more comfortable with the Fed guidance, and I'm more comfortable pricing the yield curve. Now you look, the 90 soft landing had 10-year note yields over 100 basis points above the Fed funds rate. Now they've been trading 100 or more basis points below the peak Fed funds rate. And until we get some more data, I think the ranges that we've seen tend to hold up. So further cheapening in the bond market, a little bit more stability, and you could see a bit of a relief rally. But I don't think you easily break out of the range to the upside in the near term, absent the Liz Truss moment. And I don't think you break to the downside because inflation has been sticky. And as we've seen, it takes 3 to 6 months before you really get a shift in the Fed outlook. And the market will maybe move a little bit quicker than that, but it doesn't want to be too much ahead of the Fed.
Well, Larry, it's interesting because you're the second person today that I've heard mention a Liz Truss moment today. But before we move away from potential for soft landing, what would signal a potential hard landing?
Well, the classic indicators are really going to be, I think, the corporate bond spreads, and we can look at equity pricing. So if we go to 2022 when COVID hit, I included a chart, and we can look at the chart, and you see a big jump in 2022 from under 100 basis points to close to 170, 180 basis points in investment grade bond spreads. Well, when that happens, think of it, you're a corporate treasurer or corporate CFO. You don't want to add risk when your credit spread is widening. It's saying people are afraid you're not going to pay them back.
Yeah.
When people are saying, I'm afraid you can't pay me back, do you come up and say, let me borrow a lot of money? It tends to not be a good outcome. If you don't borrow money, in that case, you don't spend money. If you don't spend money, the economy is slowing down. So, number one indicator would be looking at the credit spread outlook. That might be a little bit concurrent, but it's really at a very low level. If you look at the right hand of the chart today, it's at the narrowest spread we've seen in the sort of 5-year history or so for this chart. So they're, if anything, showing green. You might say that's more of a risk than it is a comfort. They can't get much better than this. You shouldn't see corporate spreads trading through treasuries. So that's one risk. The other would be the stock market. We can look at the S&P 500. And in 2022, it was much less dramatic than corporate bond spreads. Okay? So stocks tend to be a fountain of optimism until they aren't. And then depending upon how pessimistic you are, you can have a slower or faster downtrend in equities. So they've had a great run today, but they need to continue to have a great run to hold up the pricing. So you can look at it and say, well, gee, valuations are a bit stretched. Stocks, you look at today's price action against this chart, you can barely tell something happened. So stocks are still holding up. And again, that's a net positive for the short-term outlook. And so we're in this sort of watching and waiting and positioning around the edges kind of an environment. Looking at different sectors, finance companies got hit yesterday. Why? Borrowing costs are going to be higher. So you can look at this and say, given sectors may be better or worse meaningfully today than they were yesterday before the Fed meeting. But the overall economy, the message was, the overall economy looks to be okay. And in fact, if anything, it's doing better than the Fed expected. So it's that longer term leaning on the brake story for the Fed. And we saw that when we looked at the Fed guidance in the economic projections and the rate projections. We see that, I think, in the market reaction for the most part. Maybe the reaction was 20% of the change in the Fed guidance. So the market was expecting a hawkish outlook. It just was more hawkish than the market expected. And that had to do with the Fed predictions. Now, predictions changed a lot in one quarter, and they could change a lot in the next quarter.
Mm-hmm.
The risks going forward, I would guess, are probably lower on fundamentals. And don't try to get me to answer the political question again, because I'm not going to.
Well, Larry, finally, I do want to ask you about something that we have been hearing regarding inflation, and that is that inflation has been stickier, and indeed, we have been seeing signs of that. So, do you think it's reasonable, or could it surprise to the upside or downside when it comes to inflation? Give us an understanding of what the risks are and where they are.
Okay, well, I think there were a number of questions, in both this Q&A for Powell and in the last one on the inflation outlook.
Mm-hmm.
And it's kind of funny in that the Fed says our target is 2%. Why would you ever pick a target you're guaranteed to miss? Yet they do. I like the Bank of Canada. They say it's 1 to 3%, and
Mm-hmm. That's the range.
2% holds up as the middle of the range. But if inflation is 2.1%, do you really care? Right? If inflation is 1.9%, do you really care? It's more that you've got it under control and it's reasonably predictable. You can't put in what the good Lord left out. Inflation does not move in a straight line, and it doesn't stay stable. A lot of questions went into why are you talking about core PCE instead of headline PCE. And let's just go to one of my charts, and we can look at the last one here. And I think that would give us an idea of why the Fed talks about core PCE. A lot of TV shows don't show you a chart. Why wouldn't you talk about what's really happening in the world? Okay, on this chart I've got 3 different measures for PCE, and they all look different. If I look at 2021, the red line is the median PCE. So if you look at all of the prices that went up more and all the prices that went down more, this is the guy in the middle.
Okay.
It's one way to try to take out some of the noise. You look at the chart, it's pretty stable, but you could have a 20 basis point range over the course of a year. As we had COVID effects kick in and we saw bottlenecks come in and government spending come in 2021, we had a big jump in the green and the blue lines, which are the headline and the core PCE. But the median number was really slow to react because on average, things weren't moving. It's just that certain components were moving a lot. And those components kicked up the headline number and they kicked up the core number, which is an average of everything. So you can see the green line is the headline. It's much more volatile than the red line or the blue line. It can be 100 basis points lower with the red and the blue line barely moving, and then the headline comes up. It can be 200 basis points higher, and then it comes back. So if the Fed responded to the headline PCE, it would way overreact, and it knows it. So it doesn't respond to the headline, and no matter how many questions Powell gets on the topic, he should put up a chart. He should embarrass the reporters in the press conference and just have them at the point where they're not going to ask the stupid question again. They know this, they just ask it because they can. Here's the chart. Which one should I follow? Right? Should I cause a recession and follow the green line? Should I cause a recession and follow the blue line? Or should I look at all 3 and moderate the Fed response? What do they say today? The green line is low, but it's probably understating inflation. Look at what you pay to fill up your tank. It's lower than it was a year ago. The red line and the blue line are both on top of each other around 2.8%. How fast do they fall? Maybe 20 or 30 basis points a year on average. Could be a lot more, could be a lot less. What is the Fed projection? 20 or 30 basis points a year. So their projections are pretty consistent with how inflation has evolved in the past in a standard kind of environment. Right? They're not in a big inflation fighting mode, which they were when they hiked. They're now kind of feeling their way towards neutral and trying not to cause harm. That makes our job hard.
Well, Larry, I think it was very helpful for you to pull up that chart when it comes to PCE and actually see the discrepancy between the mean and the other lines as well. So thank you so much for joining me here at the New York Stock Exchange the day after the Fed, and for walking us through not just the commentary out from the Fed and the outlook, but also your expectations moving forward. So thank you so much for your perspective.
Thank you very much. Great to be here.
My pleasure. And that will do it for Global Money Talk, live from the New York Stock Exchange. We are so excited to bring you daily coverage here on Sempro TV. And you can check out the show anytime on our YouTube channel by searching Global Money Talk. Thank you so much for joining us. We'll be back here tomorrow morning. Have a great day.